talk about is we're going to talk about a few different things. So let's jump right into it. Why don't we talk about the just a brief overview? And this is going to be, I would say, timely because it doesn't really matter when a viewer is watching this. But let's talk a little bit about the risks and rewards of cryptocurrency in general. So, what makes it so risky, at least for right now? And then again, why is it so rewarding? So, why don't we start? We'll go around the track here. Graham, let's fire it up here.
Great.
Why don't you kick us off?
100%. So, I mean, I think one of the big reasons why crypto is risky is because it's obviously a very new technology. In many ways, for a long period of time, very misunderstood. And I think people are still trying to understand exactly what the application is going to be for this new technology that's being brought to the world. And for that reason, because of this uncertainty and this, the unknown for the applications and the potential for it, then there's obviously a lot of room for speculation. So how do you value a new technology or something that's new with potentially huge positive applications and also the potential for it to offer very little? So that's why you have this differing opinion, and depending on which day of the week it is or what the circumstances are in the market, people are either very positive and then they obviously going to throw high valuations on the various projects, and if they have woken up on the wrong side of the bed, or we have the FTX situation or macro scenarios that are more bearish, then that opinion is then illustrated in the market through the pricing, and you get big price fluctuations. So I think it's good to clarify what risk are we talking about. So the one type of risk is obviously volatility, which I've spoken to now, and then the other type of risk, which we've been very much aware of the last 12 months or so, is counterparty risk, and that's the various players in the space and the other parties that you face, and there's high or low risk depending on who those parties are, and because again the whole space has been unregulated, and doesn't have come through the same stringency of traditional finance, you have higher counterparty risks as well. So that's the risk side. But then obviously if you've been in the space for the last 10 years, you've been a participant of the greatest growth in really any asset class in the history of mankind. So that's the reward that you've been offered if you've stuck it out for those heightened risks that you've had to endure compared to other more traditional asset classes.
Okay. The risks in terms of just the normal volatility of a new asset class, or what they are. One of the things that we've been really focused on is these secondary counterparty risks. And I think we've been doing a really, really good job at looking at those and analyzing those and making sure. And Graham, what are we doing as we pick and choose the investments we make and where we make them? How are we handling that kind of risk? I'll call it the counterparty.
Yeah, sure. So I mean, I'll speak to Spectrum specifically. I mean, the one obvious thing is to diversify your risk across a number of counterparties rather than being only isolated to one. I mean, I think that's just a very basic principle of investing, especially when it comes to counterparty risk. So, as a practical example, we chose as an investment committee to always limit our risk to any one crypto exchange to a maximum of 30%. So using FTX as an example, that was our most active trading venue prior to its collapse. And I mean, say what you want about FTX from the way that the business was managed as a product and as a service to a fund manager or to even a retail trader. For me, it was the best in class, hands down. So it was really a pleasure to use that service. Unfortunately, it was just very poorly managed in the background. So that was our main trading venue. And then on hearing about some of the rumors and concerns around FTX, we then pulled back our exposure. We reduced that all the way down to 10%. So that's the second thing we do is, one is due diligence on the different counterparties. And then the second thing is keeping up to speed with what's happening in the latest developments in the marketplace.
In other words, quick to action.
Yeah. So one is looking at each counterparty, looking at it on its merits, choosing which ones you actually want to interact with, and then the second one is quick to action and receiving that information on a timely basis. We reduced our exposure, and even at that point, it was only rumors. And I think internally, we even felt at that stage it was very unlikely that FTX would have actually gone under. Obviously, the worst case scenario played out where they did go under, and we were left with 10% of our assets held there. But look, at the same time, we are a lot better exposed than many other parties that were less stringent, either in their due diligence or slower to act on the information that then became available. And look, the last thing I'll say, especially after this period where there's been a cleansing of different counterparties, is that time in the space certainly counts for a lot. So if there's an exchange or counterparty that's been around for a number of years, that certainly counts for something rather than an exchange or counterparty that's just come up new on the scene. So I think the players that have got a good track record and have been around for a long time, that's definitely those are the entities that we look more favorably upon, given the fact that they've been through such a difficult time and come out the other side intact.
Okay, Bilal, talk a little bit about the volatility of cryptocurrencies, but its potential impact on the return, right? Because you got to give up one, but you get something on the other side. Talk a little bit about that, and then what are we doing to navigate in a unique and different way so that while we can't avoid the volatility completely, what are we doing from the perspective that we tell investors such that we're still picking up a good piece of the reward? And then how do we do that such that we're one of the top 3 money managers in the world when it comes to performance?
Fantastic. No, great question, Larry. Graham, can I just ask you if you've got that handy? We did the recent update on the Sharpe ratios of the crypto to date versus the S&P to date, and how Spectrum's Sharpe ratio compared to that as well. But I'll talk if you have it, then just pop in with it.
I think
just to,
that will be very clever, Pete, to actually put that up.
I think
Sorry, guys,
that
I don't
really
have
addressed.
We'll just have to edit that. I don't have the Sharpe ratios. I've got the comparison of our performance versus other funds,
Okay.
but I don't have any recent Sharpe ratios on hand right now.
Well, it is your
Okay.
birthday,
No worries.
so it's
Getting your
I
thought.
think
Cool.
the last
So just to kick off, firstly, a lot of
that went well. Thanks, guys.
yeah, no, we spoke about it earlier. I
yeah,
thought we spoke about it.
Bilal,
Okay, so
Sorry, guys, I couldn't.
firstly, a lot of the stuff, a lot of the ideas Graham has put forward in terms of the various risks and rewards are are well comprehensively laid out. And I'd like to add, and I think he's laid it down beautifully. I'd like to add to that every day the trend is that those risks are actually getting less. So if you looked at all of those risks, the lack of regulation, the tech, the bad actors, the greed, the volatility, counterparty risk, all of these things were there 10 years ago, and they're there in any new thing that you do. But those risks every single year have become less and less. And actually what has happened is the reward that you're being given for being allocated to crypto has also been reducing. Like people who are buying Bitcoin in cents and for $1 early when the risk was that high have made thousands of percent over that period. I think where we're getting to now is the time when the risk return relationship is actually optimal. It's where the risks are actually being disclosed. You actually can find a good fund manager. You can find a professional that can highlight these things to you and that can manage these things for you, as Graham laid out with the counterparty risk. and how he managed that for FTX. So, and later, it actually may be too late because the risks will be like all mitigated, and crypto will be, in a few years' time, maybe Bitcoin has matured in its price, and the internet is now on Web3, which is Ethereum done, and all the potential has been realized and will be fully priced in, and everyone will understand exactly what this tech does and has built all the safeguards around it, and it'll be very safe. But then the upside is going to be commensurate with a very safe investment. So I think we had an opportune time in the timeline of crypto right now over the next year or so, where there is an opportunity to buy quality investment, or make quality investments into good projects which have the potential to become leaders over the next 5 years, and manage the downside risk, which we can now clearly identify, and we've had enough of a track record to see the majority of things that could possibly go wrong. So then coming, Larry, to your direct question around the volatility of crypto specifically, which is just the one risk, which is market risk. I think Graham also laid it out that over time, Bitcoin has been the best performing asset class mankind has ever seen. So yes, you see volatility swings of 20% in a day, sometimes 15. These spikes and troughs are are commonplace. But you got to look at the long term trend, and in the long term trend, even though the volatility is high in percentage terms, the standard deviation of volatility relative to the trend performance is actually low. And that's really where we explain the Sharpe ratio, which is the risk for the unit of return for every unit of risk that you take. And we've actually done an analysis where we saw that the Sharpe ratio of Bitcoin was actually higher than that of the S&P over the sample period that we looked at. We've also seen that the Spectrum funds Sharpe ratio was higher than that of the S&P of the sample period we looked at.
Yeah,
So to add to that, to
I
add to that, B,
remember.
I think if you look at, let's say 20 years ago, the investment landscape across your traditional asset classes was just considerably more attractive than it is right now. So if you look at equities, property, bonds, so if you look at any like PE ratios on your equity markets, considerably lower than they are today. Bond yields were considerably higher. So that's obviously attractive for fixed income investors. Property, I think, across the world, middle class people are just struggling to afford to buy properties, to enter the property market, living with their parents. So it's just where as a millennial or a young person in today's society do you look to invest where you can actually earn attractive returns? Back in our parents' day, back in Larry and Glenn's day, it was good enough just to buy a house and watch that grow substantially over
Back
the next.
in Larry and Glenn's day.
When they
Shit.
had those black and white TVs
I'll pull the boomer
before
card.
before cell phones.
Oh, Graham, and have you got a medical aid?
It's not just his birthday. It's not just his birthday. It's bringing age up. The ages.
It's my
Yeah.
birthday. I can say what I want.
Yes, you can.
So,
Yes,
so
you
what have we
can.
got going for us
Yes.
as the younger generation? Crypto has at least been one wealth creation tool that has been at our disposal. Given the fact that you've bought and hold over an extended period of time, and that you haven't
So Graham, I have to
panicked out.
challenge this. Sorry, I can't wait. I have to challenge this. Are you in the younger generation? Like has the younger generation officially allowed you in? I thought they kicked you out.
I may have just crossed the threshold because I'm now 60. I mean, I'm now 36.
Well, that's guys. Our own chief investment officer doesn't even know what age he is, so he's a numbers guy. Just for everyone's comfort.
It rounds to the nearest 60.
Well,
So I
yeah,
think like
clearly, guys, I could say the following. I could say the following. If I could be Graham's grandfather, I guess he is in the generation. But Graham, you and I have spoken about the Sharpe ratio before, and if I remember correctly, but you'll look, I thought the Sharpe ratio of our Spectrum fund was pretty close to the S&P and what it was. But here's something that I just thought about, which just hit me. And Bilal said, you talk about the long term, right? And so we know that the rule of 72 is always X times Y equals 72. So we know that if you give the stock market, the S&P or whatever, if you give it 12% return a year, it will take you 6 years for your money to double, and that would be considered a good rate of return. I can tell you that I remember Thanksgiving of 2017. I went in my office. We had about 40 people for dinner. I came in this office with Brandon, and I bought Bitcoin for a little over $3,000, not even $3,100, right? That's 5.5 years ago, not even 6 years ago. And as crazy as it's performed and as terrible as it was when it was at 69, let's assume it's sitting right around 24. Terrible. But fellas, in 5.5 years, that's 8 times my money. Not double. That's 8
for sure. And obviously you've endured a bumpy ride. Yeah. Yeah, you've endured a bumpy ride to get there, but that's the reward for sticking it out, right?
That's my reward. Now, was I crying that I didn't sell at 69? I guess, I could have sold a little at 69, but I just sat there and put it away, and I got to tell you, I didn't do so bad. And so if you look at our last podcast, and we said, where's Bitcoin going to be in 5 or 6 years from now, right? We're looking at least the same 8 to 10 times return from where it is today.
Well, I mean, I just want to add, again, I always talk about short memories. Larry, when we launched Spectrum and the Zenith Fund, where are we now? Is it nearly 2 years ago?
Not quite.
Almost 3, I'd say.
Almost 3.
Okay, yeah. I was thinking the year.
Okay, so I remember with our early investors, every single presentation involved the lion's share of their presentation convincing and explaining why the digital asset space or the crypto world was not a craze or a phase. And when the way we're talking now, we talk about risks. What are the risks? Where are we going with this? The biggest part of the presentation, and this is to US investors, was convincing them that this thing is real and it's not going anywhere, was the majority of the conversation. That doesn't even come up anymore. So you talk about 2017 buying Bitcoin, so on, there was an overweight mindset in the fact that, is this just a flash in the pan? Is this a fad? Is it a sexy new latest thing that's going to die out? And there, many people actually thought it was. So just from a risk point of view, that was the biggest concern with everyone, that this hasn't got legs and has no future. Well, that is not even discussed anymore. It's only strategies. What to buy, when to buy. I mean, it's a massive, and that is not too long ago, which is a massive point, really.
So and Glenn, we're often also surprised by some clients. I mean, we had a client that was almost 70 years old. We're talking a lot about age today, and he came into the boardroom and we had a presentation with Nathaniel, myself, and him, explaining to him the basics of crypto. And he knew about mining. He knew about altcoins that we didn't really watch. He really had a deep understanding of the Shanghai protocol and Ethereum and interesting thing. And to Glenn's point, the investor base, yes, still has some people that are completely new to crypto and have been so busy that they haven't had the time to have a look. But it's also full of people who are actually highly educated now and understand that there is a place for crypto in their portfolio. And then just while I've got you, just to add one more thing quickly to Graham's point about the younger generation that he's part of, or we'll wait for the viewers to
was part of.
confirm if that's accurate or not. But his claim to the younger generation, um, the investment has had some barriers to entry that um, have been systemic. So, for example, if you're young and you only have $10 to invest, you can't go to a big bank and open an account when the fees are $100 a month or whatever, or the minimum is 1,000. So, or if you come from a country where the banks don't want to deal with you, you can't invest, you can't save. If you're in a country where your currency only allows you to invest in your country, and there aren't that many opportunities for you on your own stock market in somewhere in Africa or in Asia or in South America. Um, there's a whole underserved market which is now becoming more and more um, educated and sees the opportunity to invest in, even if it's a small amount. The bulk of the population are, are the actually underserviced in the asset management world. And I think there's a lot of that's going to come into the crypto price as it matures.
Well, guys, I think when you look at the question of digital assets and where we're going, there's no question everything is going digital and technology. It seems like the two biggest things today would be, geez, like which coins do I invest and purchase in and what amount? Because who knows who's going to be the winner of the future, which is part of what we do. We pick what we believe, and we're watching it 24/7. And then the second question of risk reward is, so where do you buy them, right? So you look at the FTX. There's nothing wrong necessarily with buying Bitcoin or Ethereum there. The problem was with the exchange. So I think what's going to start happening is when the Goldman Sachs and the Fidelities and the JP Morgans start offering more and more, which they are already, that's going to lend a lot of, I think, removing some of the safety and security of at least where to buy. And then it just becomes which one to buy. And I wouldn't be a bit surprised in the future is some of these exchanges, and it's nice that there's a Coinbase and a Kraken and a Binance, although they may be first tier exchanges of where to buy most of the coins because they specialize in it. At some point, who knows, companies like ours, we may be using a Goldman Sachs or a JP Morgan exchange. Or Merrill Lynch back office, where we have corporate accounts and are doing it. And so I think that's going to come off a lot. Let's talk a little bit, if we could, about some of the possible strategies and technology that we as a fund are utilizing to mitigate risk and to increase reward. Let's talk a little bit about those. So who wants to?
So maybe I'll take the strategies, and then you take the tech. B, if you're happy with that. So look, specifically within Spectrum, what we do is we look to give investors diversified exposure to the digital asset space. So not just Bitcoin and Ethereum, but the smaller coins at the right times in our views as well. And for example, Larry, you mentioned, maybe we should expect the same growth in Bitcoin as we've seen in the last 5 years, the next 5 years. I don't think that will be the case. I think that you're going to have diminishing reward but you're also going to have diminishing volatility. I think those really go hand to hand. But at the same time, that doesn't mean that a smaller coin or smaller project cannot have similar growth to what Bitcoin has demonstrated the last 5 years. And that's the value that we add is through our team and our research. Those are the gems that we're looking for ahead of the next bull market, as an example. So we're looking for the next Solana, the next Binance coin, the next Phantom, the next Avalanche. Those were some of your real winners the last bull market, and there's no reason to expect that we shouldn't have the same type of trend occurring this time around. So that's how we're looking to optimize reward, is through generating alpha through those smaller cap coins. And then on the risk side of things, that's where we will look to move into cash and move out of those higher risk altcoins when the market is more bearish. And that's how we've been able to generate a track record of outperformance over the last 3 years, not only in bull markets with performance in excess of Bitcoin and the crypto index to the upside, but also lower drawdowns during the last 12 months, which has been the majority of the last bear market. So that's how we look to manage that. And then obviously we've spoken quite a bit about counterparty risk and what we do there. So Yabi, let me hand over to you to chat about.
Just if I may, just before B kicks off, I've just seen a headline which almost relates to our previous conversation on Bloomberg. Bitcoin beats U.S. government bonds, which is resulting in a vibe shift in the markets. So that's an interesting headline.
Very exciting, and I mean, just to support that,
which means we're dealing with sentiment shifts already.
Yeah. I mean, so let's think back. I remember the first time when Bitcoin was first mentioned on Bloomberg, and then Bitcoin started being one of the tickers. Yeah, it must have been just probably before, because he's such a young guy.
Yeah,
but yeah, I mean, we over the time we've seen crypto be reported alongside, US Treasuries and the dollar on Bloomberg, on CNBC Africa, and many hedge funds and asset managers are all aware of Bitcoin and its potential use as a hedge or a accelerated tech stock. But yeah, sentiment is changing. I mean, we've seen some rough sentiment over the last year, and I think sentiment at the start of 2023 is looking good. I'm not sure whether it is too optimistic, maybe, but I am optimistic over a few years. As we're all saying, these are great entry prices. Short term, it's always volatile in the short term. So to add on to Graham's ideas around the risk mitigation, one of the key benefits of our Spectrum Fund is that we at Stewards have priority access to RL Technology, which is a software company that has built in-house proprietary technology, which has API integration into 20 odd exchanges and banks. And what that does is that software is able to move value in the cryptocurrency world and create value in the cryptocurrency world. And it's moved over $3 billion over the last few years. And the software gives us an edge in terms of market intel and in terms of seeing volume weighted average price, in terms of seeing order book depth, and we're able to place our orders using special algorithms. So if we want to book a larger trade, we can use our software to place a trade below. On crypto you have maker and taker trades. So if you're doing taker trades, you pay more fees and you can influence the price of the market. But what we can do is we can cascade our orders in just below or above the screen price and not have to pay the taker fees. And also with the volumes that we're trading, we also get the benefit from some exchanges that give us preferential trading fees. So for example, for the retail trader, on the day something bad happens, and you're trying to sell your crypto, usually what happens is the front door of that particular exchange gets locked. And we need to trade nimbly. We need to get out the market quickly. We need to get back in quickly. And what this RL technology allows us to do is from one place manage our portfolio where we can, say press sell X million dollars, and our software, we can use our software to then distribute that ticket size to a few different exchanges, and cash out by API integration directly from our software instead of having to log into various other platforms. Which on what we've seen in the past is on days when there's major volatility, or a very market moving event, the crypto websites themselves will battle to do the onboards, or to do the logins. So yeah, so that's just a bit on the tech and how that's helped with risk mitigation. It also enables the counterparty risk management, where we can manage balances across different exchanges. We can use our software to say, okay, we'd like to have a maximum balance of 25% on any particular exchange. And when something goes to 26 to 27, it can either alert us, or it can automatically rebalance that to a different exchange to manage the treasury and counterparty risk.
I think the biggest thing that between our software technology and our ability to read and analyze, I think what's ended up happening is, and we've discussed this before, a good portion of our performance has been that ability to stay diversified, and also to step out when need be and step back in when need be, and just that kind of I'll call it a sweet spot, picking up those little bits as often as we can, and produce some good performance for us. The other thing I wanted to talk about today, and just kind of close out our podcast for today, is what do you all think about two things? Companies in the future going public via an ICO as opposed to IPO. And then will some of the companies, whether it be the Matic or Polygon or Cardano, Solana, Ethereum, will these coins, or can a coin ever pay a dividend like stocks do? Thoughts on that, guys? Who wants to take it first?
B, you want to go that route, B? You've always had a strong opinion on where we're going with the next generation.
Yeah, listen, this is 100%. It's just a matter of time, but I'm 100% sure that cryptocurrencies are or crypto digital assets are the next evolution of stocks. So as stocks were one day on paper, they then became on an exchange and dematerialized, and those companies now, if you're on the Nasdaq or the LSE or the South African JSE, um, you now list your company in that audience, in that currency, on that particular exchange to raise capital in that environment. Why would I want to limit as a company, if I was trying to raise money, why would I limit my capital raising ability to a particular geography? So it just makes sense that as future companies will want to reach a wider audience in terms of the ability to raise capital. Secondly, why would I want to trade only, US hours or South African hours when I can trade all hours? And if the database was immutable and distributed in the blockchain, I'm safer. And I can now sell my shares in a fraction of a share. So before I could only, if my share was $100, I needed someone to have $100 to buy one of my shares. Now I can sell you, a fraction of my $100 share, and you can still receive that. So there's a lot of benefit in.
So what you're saying, B, is that the next Apple or the next Tesla, the big super company, could well be listed on a digital exchange going forward.
Yeah, if I had to bet, I'd say probably Elon Musk will be the one of the first guys to try this. I mean, he's got the profile. He is playing with Dogecoin. He is listing big company. Or what he might do is he might dual list a one of his entities into crypto. But just on that note, there already are wrapped versions of traditional assets. You can buy wrapped Apple, right? So basically that is just an Ethereum contract holding an Apple share, and you can trade that 24/7, right? But what it is, it's two parts, right? So you have the whole Apple structure, and it's where it's listed and its company and everything, and then you've just wrapped it inside of a cryptocurrency as you would, like you have these Switzerland ADRs and structured products that wrap a share. It's just a structured product in Ethereum that wraps a a share, and then it makes that share more tradable. So we're already at that point today, right? The question is just, when will people stop putting the horse on the back of a truck and drive the truck, and sit on the horse? Just, you don't need the horse anymore. You can just use the car now. I think what needs to happen, and just to sort of temper my views, the reason why people want to be on the Nasdaq or the LSE is there's a pedigree to that. There's if I'm listed on the Mauritian Stock Exchange where we live here, or the Nasdaq, it's a difference in terms of the scale of your company and what capital you'd raise, and it's a different animal when you say I have a Nasdaq listed company. So what needs to happen is there will need to be a lead exchange. Maybe it's like Coinbase, maybe it's Binance. Somebody has got to be the blue chip barrier exchange, and when that exchange rubber stamps you, and you are on that hard to get um highly regulated premium exchange, then you can have many other alternative listings on various other exchanges, and then I think that relieves a bit of that pedigree issue. And also, to temper my views again, there's a possibility that we move completely off exchange, right? Do we move into DeFi, where we actually trading on GMX or Uniswap, and there are no actual exchanges, or no traditional like exchanges with a human behind it, like a Sam Bankman-Fried, that can steal our money. So it's quite exciting the way things can go. We already have the technology today to have a wrapped traditional equity and trade it in the DeFi space without humans behind it that can do anything fraudulent. So it's just now the use of that technology. It already exists.
Great. Well, okay. Guys, I think that wraps it up for today's podcast, and I will look forward to seeing all of you on our next podcast.
Thank you, Larry. Thanks, Graham. Thanks, Pete.
Right, Larry.
Okay,
Thanks,
good.
Larry.